50-30-20 rule seems to be fairly simple. 50% used towards essential expenses, 30% for that on and off splurge, luxury expenses. But it's the 20, the smallest, that could be the trickiest. It could be expanded as well if you can curtail on that 30% ratio. So how should you invest? What should you do with your current investment portfolio? I'm sure many of you, when you may be opening your mutual fund statement or your CAMS, may be pretty disappointed with the sort of decline in returns, or many of you may be facing losses as well, because those are the times that we are in. Well, let me introduce now Mr. Nilesh Shah of Kotak Asset Management. Mr. Shah, thank you so much for joining us today on The Money Show. It's a pleasure having you with us. So, Mr. Shah, I'm sure many of your clients as well may be calling you right now in panic perhaps, and they may be talking about this fall that we've seen in mutual funds, which is in line with what the markets as well have done. Panicking perhaps that, my money has depleted or my returns have depleted. What's that standard advice you give them, Mr. Shah?
We always tell our client that you must have an investment goal. You must have a financial plan. And if you can't do it yourself, you must take help of a good financial advisor. With investment goals and financial plan and good advisor, your half the battle is won. Now, today, clearly SIP returns have become negative for 3-year basis. But in the month of Jan, the same SIP returns were double-digit positive. This scenario happens when you calculate return in bear market. Past return looks very bad, but the future return looks far better. Similarly, in bull market, past return looks very good, but the future potential return comes down. So what we request investor is to follow 3 guru mantras. 1, be a regular investor in the bull market, in the bear market, in the range bound market. Second, do asset allocation to achieve your investment objective. Diversify across debt, equity, real estate, commodity, and offshore assets to create a portfolio which will give real return, outperform inflation. And third, most importantly, be a long-term investor. When you invest, you have to take volatility along with you. Risk and return come hand in hand.
That's absolutely true. Risk and return come hand in hand. You can't expect your portfolio to only be going one way up. There is always volatility associated with the markets, risk associated, with investing. But yes, the returns as well could be pretty glorious, and mutual funds have proved that in the past as well. Now, Mr. Shah, portfolio obviously comprises all kinds of assets. There's equities, equity shares, there may be mutual funds, debt and equity. Plus, then you have sometimes gold, you have even fixed deposits, in fact, could be considered as a part of your financial portfolio. So, Mr. Shah, what would be your ideal, component of a portfolio that you believe? Let's start off, of course, with a younger investor. What should a younger investor have in his or her portfolio?
So, ideally, one should invest across 5 asset classes: equity, fixed income, real estate, commodity, and offshore assets. Now, what is the proportion will depend upon what is your risk profile and what is your investment objective. If you're young but you want to invest for your marriage expenses, then there's no point in investing in equity. You better invest in fixed income products, because you will need money to spend on your marriage expenses. On the other hand, if you are an old person but you want to bequeath your wealth to next generation, then there's no point in investing only in fixed income, because you have a longer term time horizon. So you should invest some part in equity. So don't just look at your age and try to create a standard asset allocation. Look at your risk profile, look at your investment objective, and then create a portfolio with an aim to generate real return. Your portfolio must outperform inflation. That's the only way you can generate real return on your portfolio.
You know, Mr. Shah, many a times, especially for retail investors, they are busy with their own lives. They may be doctors, teachers, engineers, and so on and so forth. The very important activity that they miss out on doing is reviewing your portfolio. It's usually invested and forgotten, or those auto debits of SIPs keep continuing, and many a times people don't go back into their CAMS or their mutual fund statements, or just holistically look at their portfolio and give it a review. How important do you think is that exercise?
So if you look at a well manicured garden, do you think it was created just by throwing good seeds, giving good fertilizer, and giving waters once? Of course not. The garden was appropriately cared by cutting out the weeds, by watering on a regular basis, by providing herbicide, pesticides when the need arises, by giving nutrients through fertilizer. The same way, a good quality portfolio requires same care like a garden. You have to invest in quality instruments, quality assets, whether it's debt, equity, commodity, real estate. You have to invest in quality assets. But more importantly, then you have to provide attention to it. Many of us work 24 by 7, 365 days a year to earn income, but we don't put attention on generating extra return from your wealth by taking appropriate care. And hence, my recommendation will be at least 3 times a year, you should value your entire asset allocation. Are you in right asset class? Is there a need to restructure your asset allocation? Are you on your way to achieve your investment objective? Many people believe they will be able to do it on their own, and then they keep on postponing taking decisions. You go to a doctor for your physical health, you must go to a financial advisor for your financial health. You don't go to a chemist and buy out medicines for treating your disease. Same way, you just don't walk over to a mutual fund or any other financial instrument and buy something to create your financial portfolio. You need to create a plan, and you must have discipline to follow that plan.
Well, yes, a financial advisor is extremely important. Just as self-medication can be dangerous, DIY wealth creation as well could carry along with it its own set of risks. Mr. Shah, when one is reviewing his or her portfolio, what are the things to keep in mind? See, as time progresses, maybe your financial goals may change a little. There may be some changes in the markets as well, which may have caused a certain section of the portfolio to underperform, a certain section to outperform. How should all of that be viewed into when you're reviewing your portfolio? Do you dump the losers, or do you hold on to them? When do you know when you should exit an MF or increase a SIP as well? What are the telltale signs?
So when you sit to look at your asset allocation, you need to evaluate it on 3 parameters. First, cut your mistakes. All of us are not God. We were bound to make errors. Now, if you are invested in an instrument which is not delivering or which has become risky, you must cut your losses. Many a times what happens, people cut their profit and continue with their losses. Never make that mistake. Allow your profits to run and cut your losses. Second thing is my financial goal achieved or not? Now, let's say I started investing with a view for my daughter's education. Now, this was a long-term investment when my daughter was born. It was still a long-term investment when she passed out her SSC. But when she's graduating and she's planning to go for a management education, then certainly this is no longer a long-term goal. I have to make adjustments in my portfolio, keeping in mind my investment horizon. Third prism which your portfolio should go through is what is the valuation of that particular asset class. If bull market is there in equity, your equity portfolio would have delivered great return. It's time to take some profit out because your equity allocation is more than what you need. So looking at the valuation of asset class, looking at the objective of your investment, And looking at the track record or performance of that investment, you have to make adjustment. Now you ask one very important question: should I dump the loser? Well, the definition of loser is very, very critical. Just because a fund has underperformed does not make it a loser. You have to always evaluate it against the benchmark index. Many investors complain that Nilesh, bhai, your fund is down 20%. But when my index is down 40% and I'm down 20%, it's a great performance. When my index is up 20% and I'm up 15%, it's a lousy performance. So you evaluate whether this fund or whether this instrument is able to add value vis-a-vis a benchmark index or not. Positive return, negative return is part and parcel of game. You can't move away from it. You can't stay away from it. You'll have to accept it. But look at the value addition done by the investment to your portfolio.
All right. Mr. Shah, when we told people that Mr. Nilesh Shah will take a look at your queries that you may be having with respect to personal finance, but obviously queries came in from far and wide. I don't think we'll have time to take many, but I'm going to try and squeeze in as many as we can. So let's take on board our very first question. Santu Mondal writes into us saying, what should one ensure they should do for healthy financial planning, financial resolution of kinds? For example, tax planning, portfolio review, insurance, family budget, etc. That's the first part of his question. And second part, how should we use this home quarantine period from a financial point of view? For example, have a discussion with the members of the family on money or on investment. A very interesting question, and I'm sure, Mr. Shah, this quarantine has given a lot of people to actually reflect on many areas, money being one of them. So how do you, or rather, what would you recommend to viewers like Santu Mondal?
So I will say follow a couple of principles for good financial planning. First, income minus expenses is never equal to savings. It's always income minus savings equal to expenses. That way you will install habit of savings for yourself as well as your family. Second, please follow Warren Buffett's rule. Rule number one, never lose money. Rule number two, never forget rule number one. When you're making investment, you're making with a view to make money. You should not take risks which you can't afford to take. Third, when you are investing, you must invest with a goal in mind. There are a lot of people who start their SIPs, but they don't know how long they are going to continue, why they are doing it. Many people park money in debt funds, saying that at appropriate time I will shift into equity, and they remain invested in debt for a long period of time. These are not the ways to manage money. You must have your investment objective. You must have a financial advisor who can craft a strategy to achieve your investment objective. There should be regular review so that you know you are on the way to achieve your financial objective. When portfolio is not performing, there should be analysis to figure out why it is not happening. And that combination repeated over a period of time will build the necessary financial discipline. One most important thing is that in many Indian households, financial matter is never discussed with woman, with wife, with daughter, with mother. Don't make that mistake. Please involve them in financial decision making. One, you will benefit from their wisdom. I can assure you that most women have far better common sense to analyze investment and take investment decisions than we give credit to them. So you will benefit from their common sense and wisdom. Second, in case anything goes wrong with the person, the family should be aware of where his wealth is, where his investment is, and they should be in a position to do a seamless transfer. Ultimately, that's the objective of wealth, that if something goes wrong, it should be able to protect your family. So make discussion about finance part of your dinner table discussion.
Yeah, that's very important. Involvement of everybody, in the financial process. Everybody should know, your family rather should know, the financial assets that you have, so that God forbid if something happens to you, they know where they can fall back. Okay, let's move on and take on board our next query from Vinod Katyal. He says, I have started redeeming mutual funds since November 2019. He managed to redeem almost 9 lakh rupees. He was left with 25 lakh rupees, but the value of that has now fallen to 18 lakhs. Now, his conundrum, Mr. Shah, is that he needed this money for his daughter's marriage, but now he's facing a 7 lakh rupee loss. Yes, unfortunately, many financial goals may be, coming during this coronavirus period, and now is the time when it really pinches your pocket to redeem your mutual funds, to really use them for your goals. In Mr. Katyal's case, it's his daughter's marriage, which is actually fixed this year. So, Mr. Shah, what would you advise people like Vinod Katyal?
So, Vinod bhai, when you were redeeming money in November 2019, why did you redeem only a small portion and why not full portion? I assume your daughter's wedding is this year. With that kind of time horizon and COVID-19 looming on horizon, you should have redeemed everything. So that was one error which we can't rectify going into the past, but you should keep in mind going forward. Second thing, your wedding is, if it's going to be in next 3-6 months, it is time to redeem your entire money from equity, even though there is a loss. These monies were invested for your daughter's wedding. If markets were good, you could have given a far better wedding to your daughter. But don't worry, whatever money you have, use it hard, negotiate smartly with the vendors, and still deliver better wedding to your daughter. This loss of 7 lakh rupee is daunting, undoubtedly. It hurts a father's feeling when he's not able to provide better wedding to the daughter. But you must remember what is your investment objective. If you'd have incurred 25 lakh expenditure, there would have been one kind of wedding. With 18 lakh rupee and some interest over next 3-6 months, there will be another kind of wedding. But spend this money wisely to create the same experience, rather than hoping that my 18 lakh will become 25 lakh as markets will move up and I will be able to do my daughter's wedding. You never know, markets can go down also, and this 18 lakhs can erode further. So focus on your investment objective.
All right. Okay. Well, unfortunately, yes, errors like these sometimes could be, unrectifiable. But yes, that's Mr. Shah's advice for people like Vinod Katyal. All right. We have time for one last query. Karthik writes in saying, I haven't started investing anywhere, but I have started exploring options. He is young. He's 24 years old, working in UAE, and he can manage to invest 50,000 rupees per month. Now, Mr. Shah, you've already given us a nice gist of how to start investing in the earlier answers, but for the benefit of Karthik and many other 20-25-year-olds who are watching, if you could just sort of reprise that answer and that advice.
So Karthik, you are late in starting. Moment you start earning, you should have developed the habit of saving. Even if you were saving 1,000 rupee, 2,000 rupee, it's a good habit to have. So number one, going forward, please ensure that you must save minimum some amount every month. Second, your own target is 50,000 rupees a month. What is the reason why you are saving? Is it for your marriage? Then you have to create a portfolio which is part equity, part fixed income. If it is for your retirement, then it could be far more tilted towards equity. So my recommendation based on limited information will be start doing regular investment, ensure that you save some money and diversify across equity or fixed income depending upon your time horizon and investment goal.
Right. Excellent. Well, we've received so many more queries, but due to paucity of time, we'll have to put them on hold right now. But Mr. Shah, once again, appreciate you spending your time, and sharing your very valuable advice with our whole host of viewers who are watching you. And, I'm sure penning down all of your thoughts to paper. Thanks so much once again, Mr. Shah, for joining in. Well, with that, we're out of time on this episode of The Money Show. Tomorrow, of course, is the last the session 5, episode 5 of Personal Finance Unlocked, and this one will be about spending, because at the end of the day, that's what you're earning money and that's what you're investing money for. So we'll tell you how you can get your money's worth in tomorrow's episode. Stay tuned.